This is a topic on the subject accounting for business decisions and IFRS. We are in accounting for business decisions, chapter standard costing, and this is an exam problem. Here the question is to find out the material variances. Material variances means differences between the actual cost, standard cost and actual cost. To do this, there's a very simple technique. All that we'll have to do is memorize a few formulae. Here, standard costing means we have material variances, labor variances and overhead variances. These are the three categories of variances. All put together, we have variance analysis. Variance means variation from the standard, actual varying from the standard. So we are going to constantly compare the actual cost as against the standard cost, and the difference being adverse variance or favorable variance. Now coming to the variances, here today we are going to focus on material variance. So the whole focus on material variances, the formula for material variance is material cost variance. All this is in abbreviated form. Up to here you'll see something in the abbreviated form because it is nice and easy for us to memorize in an abbreviated form than write the whole thing as material cost variance is standard cost minus actual cost. All this full blown up value is not convenient and nice to memorize. So it's the short form is used here, and however whatever has been abbreviated has been expanded and given here. Even in the exam you will have to do the same thing. You have to put the formulas in the abbreviated form, separately give this legend, give the expansion of each abbreviation and put it over here. With this is going to enhance the presentation. Presentation is a very important thing in your exams. At the end, the difference between standard cost and variable cost, if it is positive value, it is called favorable, and if it's a negative value, it's called adverse. Further, coming down to standard quantity for actual production, every time we say standard cost means standard cost for actual production. Here standard cost for actual production. Here standard quantity means standard quantity for actual production. So what is this standard quantity for actual production? Standard quantity for actual production means standard quantity for getting one unit, standard quantity per unit into actual production, actual units produced. So to produce these number of units, each unit taken of standard material, so this is going to give a standard quantity for actual production. The quantity utilized should have been utilized in the standard form to get the actual output. Continuing further, actual price usually wouldn't have been given directly in the problem. We'll have to arrive at this. We'll be given value of materials purchased, and we'll also be given quantity of material purchased. Value of material purchased divided by quantity of material purchased will give us actual price. With this, we are through with the formula sheet. We'll see how we can utilize this formula sheet and apply it to this problem, and let us see how simple things are and how easily we can solve this. Coming to this portion, the first giving you a tip on how to solve this. If you drop a grid which gives you the standards and actual price and quantity, this grid, if you are through, your solving becomes so simple. So if you do not have this ready, prepare this and then start working the problem. You'll find it so easy, convenient. You'll find solving this problem becomes a pleasure. here standard price SP, actual price AP, standard quantity SQ, actual quantity AQ. If these things are ready, we are halfway through. Now standard price per unit, this means standard price per unit. Let us search for this in the problem here. Standard rate of materials, this is standard price, 2 rupees 50 NP. This we have this standard price per unit. Standard quantity means standard quantity for actual production. This is not ready, so we'll have to utilize this formula, standard quantity for actual production, and arrive at it. Standard quantity for actual production is as per this formula, standard quantity per unit into actual units produced. Standard quantity per unit given in the problem is standard quantity of materials required per ton of output is 30 units. So this is 30 units. Output during the period, that is output actual units produced is 80 tons. So 30 units into 80 tons. To produce each ton, we require 30 units. So to produce 80 tons, 80 into 30 will require 2,400 units. So this becomes standard quantity for actual production. This is what we want. So now we have standard quantity for actual production. We have arrived at it, 2,400. Actual price is not directly given in the problem. Nowhere we find actual price. We have this formula, actual price is equal to value of material produced by quantity of material produced. Value of material produced is value of material produced in this problem is value of material purchased is 9,000 rupees divided by quantity of material purchased is 3,000 units. So actual price is equal to 9,000 divided by 3,000 will give us rupees 3 per unit. So this 3 we are going to write here. Actual quantity, actual material purchased is given over here, 3,000 pieces. Of this 3,000 pieces, actual quantity is quantity purchased minus closing stock if any, very important, closing stock if any. In this problem, we have a closing stock of 500 units, stock of materials at the end. So we have purchased 3,000 units and we have a stock of 500 units left behind. So we have actually utilized 2,500 units. So actual quantity is 2,500. Once this grid is ready, once this block is ready, then you see how easy it is to solve the problem. We'll utilize these two sheets, start solving the problem. I'll start putting this template, utilize these numbers, this grid, and we'll run through this in the end. Coming to this, standard material cost variance is standard cost minus actual cost. Standard cost again is standard quantity to standard price. Actual price into actual quantity. If I have set standard quantity and standard price here, if I write in standard price and standard, it doesn't make any difference. 2 into 3 is equal to 3 into 2. So I've just interchanged. Now here, standard price given over here is 2 rupees 50 NP. Standard quantity is 2400, and here standard actual price is 3 rupees, actual quantity is 2500. So if we have this minus this is going to give us material cost variance. So 2400 into 2 rupees 50 NP is going to give us 6000. 3 rupees into 2500 is going to give us 7500. So 6000 minus 7500 is going to give us a negative of negative. So it is called adverse. We said if there's a negative value, we are going to use adverse. So this is 500, 1500 adverse. So we have a negative of 1500, material cost variance is 1500 adverse. This is further split into, we have material, coming to this, material price variance and material usage variance. Material price variance is actual quantity into standard price minus actual price. Actual quantity is 2500. Standard price is 2 rupees 50 NP. Actual price is 3 rupees. And here the formula over here for material usage variance is standard price into standard quantity minus actual quantity. Standard price we know is 2 rupees 50 NP. Standard quantity 2400. Actual quantity 2500. And now it's just a calculator work. 2 rupees 50 NP minus 3 rupees will give us a negative 50 NP into 2500 rupees. 2500 quantity units will give us 1250 negative. 1250 negative means, as discussed over here, negative means adverse. So 1250 negative. So 1250 adverse. Coming to this place, we have 2400 minus 2500 will give us 100 adverse, 100 minus into 2 rupees 50 NP will give us minus 250, negative 250. Negative means adverse. We can have a cross verification. 1250 adverse plus 250 adverse. If we total this up, if we add them up, we'll get 1500 adverse. 1250 adverse plus 250 adverse, 1500 adverse. So material price variance plus material usage variance added up together is going to give us material cost variance. So 1250 material price variance, 250 material usage variance. Both of them clubbed together, we get 1500 material cost variance. So let us quickly run through this. A quick recap. Step 1, use the standard template. All that I want to impress on you is, if you have mastered this sheet, it's a Bible, Quran, Bhagavad Gita for your standard costing. Once you do this, you're through. You can solve any problem. This is what I want to impress on you. Have the sheet, memorize the sheet, you're through. You're a master of standard costing, at least to the material variance is part of it. So again, let us see how we can utilize this sheet and solve this sum. This is a problem on material cost variances, material variances. The grid, we'll have to obtain this grid, standard price, standard quantity, actual quantity. Once this is through, it's all just application of the formula, and we'll see how it is done. Here again, standard quantity is not given in the problem. We'll have to arrive at standard quantity. Standard quantity per unit into actual units produced. 30 units into 80 tons, 2,400 units is the standard quantity for actual production. Actual price is not given in the problem. Standard materials purchase is 9,000 rupees value. Standard quantity purchased is 3,000 units. This divided by this will give us actual price per unit. So this is actual price per unit. So now we are ready with this grid, and we'll see how we can arrive at this. Actual quantity is quantity purchased minus closing stock. So we have actually utilized only 2,500 units. So with this, now coming to the problem. Material cost variance is standard cost minus actual cost. Standard cost for actual production. Standard price into standard quantity. Actual price into actual quantity. All this is utilized from the grid. Standard price is 2 rupees 50. Standard quantity is 2,400. Actual price 3. Actual quantity 2,500. All arithmetical work. 2.5 into 2,400, 6,000. 3 into 2,500, 7,500. If you sum it up, minus 1,500. So it is adverse. Here, actual quantity into standard price minus actual price. Actual quantity 2,500. Standard price 2 rupees 50 NP. Actual price 3. Solve it, 1,250. Standard price 250. Actual quantity, standard quantity 2,400. Actual quantity 2,500. Solve this. So this plus this is this. Done.